US GDP numbers coming in at 2%. You've got some worry coming around there. Remember, last quarter as well, the expectation was somewhere closer to 3.1% from where it came down to 2%. This time around, I think it stayed with the expectations of about 2.5%. Let's talk a little bit more about this with independent emerging market commentator Geoffrey Dennis, who's joining us on the phone line from California. Geoffrey, thanks very much for taking out the time and speaking with us this morning. A quick comment on the state of the economy in the US and the GDP numbers that came out yesterday in the evening at about 2%.
Well, the economy's slowing down. I think there's no doubt about that. And I think it's just a question of, how rapidly the economy's slowing down. Of course, you'll get quarterly variations, but basically the trend is towards slower growth. And you had a drop from obviously just over 3% annualized growth in Q1 to 2% annualized growth in Q2. Now, that's the headline conclusion. The details are this economy now is almost entirely dependent on consumer spending, and the notable detail of this particular release was how weak investment was. And you would expect that given the uncertainty businesses are facing, given the trade war, and of course you're getting very little contribution from the export side, net exports. And so I think this economy is slowing down, and I think the risk of recession at some point in the next 12 to 18 months is actually very high, and I think that's what the medium-term trend is.
We had a conversation with a lot of people from JP Morgan at their JP Morgan India Summit, and they said that their probability of a US recession that they had factored in earlier on to be somewhere closer to 23-24% has gone up to about 45%. Is that something that most are factoring in?
Yes, I agree with that assessment. In fact, my probability figure is higher than that. I've been saying to people and posting on this that I think the probability of a U.S. recession before the end of 2020 is over 50% now, and I think we've got to keep this in a bit of perspective here. Obviously, for the politics, it would be very inconvenient for President Trump facing re-election, of course, in November 2020. But I think given how devastating the last downturn was, the global financial crisis, which was an extraordinarily deep recession, much the deepest of the post-war period, I think the fear is that if we get a recession, it will be as bad as it was in 2008, and it won't be that bad. I think it's going to be a much more normal recession. As you'll all know here, this economy has been growing now for over 10 years. It's a record length of GDP recovery, and I think we're long overdue a pause in growth, a recession, if you like. And I don't think a slightly more than 50% possibility of a recession in the next 12 to 18 months is all that dramatic a forecast. Nor do I think it's necessarily going to be a devastating recession by historical standards.
Just comment on, you briefly touched upon business investment and how that is slowing down. It's declined at a rate of 1% annualized rate last quarter, and that's been the steepest decline since the fourth quarter of 2015. Is there any expectation of a turnaround there, or if this continues to remain at these levels, how grave could the matter be?
I don't think there's any obvious reason why we're going to get a turnaround. Before I come back to investment, I think the risk to these numbers overall is that the driving force of this economy, the consumer, slows down. That would be the really big risk. And I think that's also possible. Perhaps we'll come back to that. But on investments, what is holding corporate investment back is the uncertainty over the business environment because of not just because of the trade war, but obviously the trade war is playing a role. Now, I think what's also interesting about that is, of course, you had this huge tax cut at the end of 2017, including in corporation tax, corporate tax. And I think the fact that investment is so weak is just telling you that companies simply use that money to pay dividends and to buy back shares. And if you layer that general result from the fiscal package on the trade war, which of course has escalated so dramatically over the last several months, I think it's no wonder that you're getting weak investment. So you'll get, as I say, you'll get volatility in the quarterly numbers. But I think until you get clarity on the trade side, which doesn't look as if it's going to happen very soon at all, I think the investment numbers are simply going to get worse.
Right, and that may not all go well for the equity markets either. Geoffrey Dennis, thank you so very much for joining us. Really appreciate you taking out the time with quick comments coming in there. So it is a bit of a concern with regards to growth and the investment climate there in the US. But